Hello everyone. I'd like to illustrate some of the situations or things that we come up against in chapter 1 and 2 using an example here. And what we're trying to illustrate is some things that sometimes can trip up students as they try to identify who files a tax return and what's affected on that tax return. So our example here, we're going to have Tom and Erna. We're going to label them the parents. They have a son, Martin, and they have, let's just say that it's Tom's parent, mother, grandma, if you will, Sophia, and they all live in the same household. So that is important to our example here. So when we go to file a tax return for these individuals, we actually have 3 separate tax returns that could be filed. So we have Tom and Erna. Now, the only time you combine income is when 2 people file jointly. So you have the different filing statuses: single, married filing jointly, married filing separately, head of household, and then you have qualifying widower, which is really just married filing jointly. But Tom and Erna would be able to choose between 2 filing status. They could file, because they're married, at the end of the year, they can choose either married filing jointly or married filing separately. Typically, married filing jointly is the most advantageous. And so as such, they would file one tax return for the 2 of them. This is their incomes. One of them makes 42, one makes 43. You would add that together. That would be their income. So that income is combined. So even though Martin lives with them and makes money, his income is not reported on his parents' return. This is not Tom and Erna's income. Only their income is reported on this return. Martin would file a tax return of his own, where he would report that the amount of his income. So both of Tom and Erna are the same age, 48, so they're not old enough to have any additional standard deductions. So their standard deduction for 2019 would be $24,400. So they would take the 42 plus the 43, and assuming that standard deduction, which is all we've learned about so far, is what applies, you would subtract that amount, the standard deduction of 24,400, and you would get their taxable income. So we'd add together what they got on their W-2s. If I can make my math work. And subtract the standard deduction, and that would be their taxable income. Now, if you were asked what AGI is, in this case, since there were no other adjustments for AGI that we'll learn about in later chapters, it would just be the 85, the 2 together. Subtract this standard deduction, and then you have the taxable income, which then is looked up on the tax table to get the tax liability. Then you subtract from that the amounts that they had paid during withholding or any credits, which in this case they would be eligible for at least the child tax credit mentioned in chapter 1 and 2, which would be $2,000 for their qualifying child who's under 17. So that would be reduce the amount they would actually have to pay. It does not affect their taxable income. It affects their tax liability. So you find the tax liability after you get the taxable income. And in this case, if it's under 100,000, from the tax table, and then subtract the credit, or any credits and amounts paid. And then you get either a refund if your amount of the credit and tax paid is more, or amount owed. And we'll go a lot more into additional credits and other things that might be available in a later chapter. So that's what Tom and Erna's roughly would look like on their 1040. So what does Martin have to do with it? Now, he would be listed on their return as a dependent. But you notice that that amount, the dependent, does not affect any of these calculations. It would affect the credit down here because the child tax credit is only available if someone is their dependent. Okay, but it does not change the standard deduction and doesn't affect how you look up the amount that they owe, any of that type of thing. So son Martin is going to have his own tax return. Now, because he is a dependent, his standard deduction is not 12.2 for a typical, he's going to file single because that's what he is. All right, he's obviously not the head of a household. He doesn't have any dependents of his own, so he is going to file single. So the first thought we'd say, okay, he's got a standard deduction of $12,200, but he doesn't because he's a dependent of someone else. So he reports that he's a dependent of someone else, his parents in this case, and therefore his standard deduction is the amount earned plus up to $350 of unearned income. So this is his summer job earnings, and this is some interest he earned on an account given to him by his grandpa, let's say. So he has two sources of income. So he's going to report that on his tax return, but his standard deduction is going to be $62.50. Now technically it could be, you could say it's $63.50 because you get $350 of, but typically we just put it up to the $350 if the amount of interest or unearned income is less than the $350. We just use that, the amount of the income, and so his taxable income is zero. So if he had anything withheld, okay, so obviously his tax liability from the tax table is also going to be zero. If your taxable income is zero, your tax liability is zero. He's not going to have any credit, but he may have paid in. So he may have had some withheld from that job, his summer job, okay, that amount. And so he would get a refund of that whole amount. So he did affect the parents' return in that there's the child tax credit and that he's listed as a dependent, but it didn't affect the calculations of income. His income is separately on his own 1040. There is no 1040EZ anymore. It is just a 1040. The schedules much of the detail has been moved to schedules, and so the 1040 is simpler, and therefore those with more complicated use the schedules, and those that have a simple return like Martin would just use the 1040. All right, so he would be a dependent and a qualifying child. You learn the criteria for that. Notice that it did not matter what his income. We did not care in determining whether he was a dependent on his income, because he is under the age of 19. So if you're a qualifying child under 19, then income does not affect your ability to be a dependent. He could be paying a lot of his own expenses, but all we need to know is that he didn't pay more than half of his own expenses. So with someone other than a child, you may have to look at it because then the people claiming the dependent have to provide more than 50%. This is a different test in that the the son cannot be providing more than 50%. That's pretty easy to determine. He's most probably a chunk of this money is in the bank at the end of the year, sort of thing, or he's used it for fun stuff, and while mom and dad pay all the bills. And that's what's assumed for someone, an actual child. Now, grandma, who lives with him, is a little different story. Okay? Because she is not a qualifying child, she's too old, she's 72, all right? She also could be a dependent but they have to look and see, did they provide 50% of her support? Well, if she's living with them and eating with them and all that kind of stuff, then chances are they're providing more than 50%, and her $7,200 of Social Security is used to, pay for some of her medical bills maybe and things like that. So she would also, if that were true, and they provide 50%, okay, she's a relative, she's with them all year long, and even if she were in someplace else, like a care facility, and they still provide over 50%, she could still be a dependent. So she would be listed as well on the return, but again, it's not going to affect the calculation of the standard deductions, because she's going to also file her own return. So she would also have a standard deduction, because as a dependent, of $1,100 or earned income. Now, $7,200 is not earned. If it's Social Security, that's not what's considered earned. Wages, that sort of thing, is earned income. So she would be working with the $1,100 standard deduction as a dependent. Now, can she be a dependent? Well, she can be, even though she made more than the amount that is allowed for it to be a dependent, because she's a relative, and all of this income is from Social Security, so it's not reportable income, it's not taxable, and therefore would not count towards determining whether or not she made too much income. If the $7,200 was all, say, interest on a big chunk of money in the bank, that would be taxable income, and therefore it would be included in her income. And she would have income that was too high, and therefore she could not be a dependent, because she would have income that was too high. $7,200 would be above the threshold. So we'll learn later that Social Security has some special rules about what's included as income. And the $7,200 all Social Security, actually none of it would be included in her income. And so she would have zero income. Her standard deduction would be $1,100, and she would actually have a negative taxable income of negative $1,100, and obviously would have no tax liability. In fact, she wouldn't actually need to file, okay, if this were all Social Security. Now, if this were all interest, then this would be important, because she would report the $7,200, she would take the standard deduction of $1,100, and she would have $6,100, and then she would look up her tax liability from the tax table and apply any credits to that, things like that, and go through the same process. Or actually, that would not be true, because if she were making $7,200 of interest income, all right, she would not be a dependent, right? Because she would have too much income. So because she cannot be claimed as a dependent, she would be subject to the regular standard deduction for a single person, and her taxable income would be negative $5,000, and her tax liability was zero. Having a negative taxable income does not mean necessarily that you get a refund. To get a refund, you usually have to have paid in money, but sometimes there are credits that can result in a refund when we get into the credits more in depth in a later chapter. Okay, so this would be, even though they're all in the same household, and all of them affected mom and dad's return, they were all on there, they still have their own return, and because she's over 65, there would be extra, not that she needed it, extra, okay, standard deduction. So you'd add for the 12,200. This is the easiest thing to forget, is the extra standard deduction. So it wouldn't be just 12,200, it would be 13,850. So you add those two together. Notice this is not extra standard deduction to be added over here to Tom and Erna. Even though she lives with them, this is only on her return, not on the parents' return. Any difference? Okay, that's the illustration. So now you've seen kind of this household idea, how it breaks down, and how each of them affects the others, but still has their own separate return.